Hello everyone and welcome back to another video. So recently I finished reading this book right here called The Interpretation of Financial Statements by Benjamin Graham. So in today's video, I just want to share some of the highlights and key things that I found from the book. Now, for those of you who may not know, Benjamin Graham is also the author of The Intelligent Investor, which Warren Buffett says is the best book on investing ever written. And Warren Buffett actually says that The Intelligent Investor is kind of like the Bible of investing. And again, this book is written by the same guy. It just kind of summarizes like the specific things that you will find on financial statements like inventory, revenue, cash flow, book value, and what all of these different things actually mean. Now, I'm not gonna lie, I don't think that this book was actually worth the money, but there was a few very good key highlights and things that I found in it, and that is what I want to share with all of you today. However, before we get into the video, I just want to let you all know that this video is sponsored by Morning Brew. Morning Brew is a free daily newsletter that gets you up to speed with all things business, finance, and tech in under 5 minutes. Before I started using Morning Brew, I would have to scroll through tons of articles and ads to find relevant information on the stock market and what is going on. And now, Morning Brew sends me an email directly to my inbox every morning with everything I need to know, which saves me a ton of time. Just recently, they let me know that CP Rail is trying to acquire Kansas City Southern for $25 billion. And if this deal ends up going through, then CP Rail will be the first railroad to connect Canada, the US, and Mexico. So far, CP has fallen on this news, but long term, I do think that this could be a huge deal for the company. Signing up to Morning Brew is also totally free and takes less than 15 seconds. All you have to do is hit the link in the description of this video. So thank you to Morning Brew for sponsoring today's video, and now let's get on to my notes from the interpretation of financial statements. Okay, so the first two passages that I want to share have to do with goodwill and intangible assets on the balance sheet. For those of you who may have been watching my channel for some time, you probably already know that I do not like high goodwill or growing goodwill on a balance sheet. This is simply because both goodwill and intangible assets usually end up on the balance sheet when a company does an acquisition, which also means that if a business's goodwill and intangible assets are growing, then they're most likely doing a bunch of acquiring. Now, I don't absolutely hate acquisitions, but I also do not love them. I simply prefer to see a business growing organically. And the way that you can tell if a business is growing organically is if the goodwill and the intangible assets are not growing. So with that quick introduction, let's talk about what the book has to say on page 9, where it says, "On the other hand, we find that in the majority of strong companies, the goodwill, which constitutes one of their most important assets, either does not appear on the balance sheet at all, or is given but a nominal valuation, usually $1. This right here tells us that Benjamin Graham believes that fundamentally strong companies either do not report goodwill, or the goodwill on the balance sheet is not usually high. And when I read this, the more I thought about it, the more that this actually made sense. If a business is in fact a strong one, then it most likely does not need to be going out and doing a ton of acquisitions to support or continue its growth. Or in other words, if the business truly is a strong one, then it should be seeing all of its growth organically, which again, I prefer as an investor. Low goodwill was actually one of the main reasons why I love Trulieve so much more than their main competitors, and one of the key reasons why I chose to invest in them over their competition. If we go back and take a look at my initial research on this business, we can see that I highlighted the fact that Trulieve's assets are growing due to the cash position increasing, along with their property, plant, and equipment, and not from the goodwill and the intangible assets. Their intangibles actually dropped from the end of 2019 to June 2020. This simply means that the assets on the balance sheet weren't growing from intangibles and goodwill being added to it. Now, if we take a look at one of their main competitors, their intangibles increased by over $200 million and their goodwill increased by $110 million in the same time frame. In total, their phony assets increased by about $330 million within 6 months, and now made up almost half the company's total amount of assets. This right here told me that Trulieve is growing 100% organically, and their competition was growing through acquiring. What was also surprising to me though is that despite Trulieve doing no acquiring and growing 100% organically, their revenue was still growing at the same rate as their competition. What this ultimately means is that Trulieve's organic growth was totally in line with the competition's acquired growth. So which one would you prefer, paid or organic growth? And again, this was all incredibly easy to recognize just by paying attention to the goodwill and the intangible assets on the balance sheet and looking at how quickly they're growing relative to the overall company. And I see this as a clear sign that Trulieve has a much more solid business because all of their growth is totally organic, and it seems like Benjamin Graham would have to agree. But let's move on to the second quote, and this one comes from page 23, where it says, "In general, it may be said that little, if any, weight should be given to the figures at which intangible assets appear on the balance sheet. Such intangibles may have a very large value indeed, but it is the income account and not the balance sheet that offers the clue to this value. In other words, it is the earnings power of the intangibles rather than their balance sheet valuation that really counts." This quote right here explains why Benjamin Graham believes that intangible assets should be removed completely from the analyzation of a balance sheet. He is simply saying that it is the earnings power of the intangible assets that really matters, not their estimated worth on the balance sheet. This basically means that Benjamin Graham believes that the intangible assets are already being valued in the earnings power of the business. So if you're someone who uses a PE ratio to value a business, then the intangibles are reflected in the PE already. Since the intangibles are already accounted for in the price to earnings ratio, then you shouldn't value them twice by placing them on the balance sheet or using them in a book value calculation. This would also mean that any business with high intangible assets and low earnings power could be seriously overestimating the value of their intangible assets. Personally, I think it's pretty hard to estimate the value of an intangible asset, and I also think that it leaves a lot of room for error and potential manipulation on a balance sheet. This is also why Ben Graham and Warren Buffett recommend using the tangible book value when looking at a business and paying attention to that instead. The tangible book value is found by taking the total book value and subtracting the goodwill and the intangible assets, which are also what Warren Buffett calls phony assets. And I think that understanding why Benjamin Graham and Warren Buffett dismiss intangibles is important, which is also why I thought this quote from the book was important to share. But now let's move on to the third and final quote from the book that I want to share. And this one talks about small cap stocks, which I love. So right here on page 10, it says, "Where the purchase is made for speculative profit or long-term capital gains, it is not so essential to insist upon dominant size, for there are countless examples of smaller companies prospering more than the larger ones. After all, the large companies themselves presented the best speculative opportunities while they were still comparatively small." What this passage is trying to say is that not all investing must be done in overly large companies or industry leaders. Ben is saying that there are countless examples of smaller companies prospering more than larger ones, and that sometimes the best investment opportunities actually come from the relatively small companies. Basically, Ben is saying that there is great opportunity in small cap stocks, and us as investors should not rule out small cap stocks just because they're small. Once again, Warren Buffett agrees with this, and Warren believes that retail investors should actually focus on small cap stocks for a couple of reasons. The number one reason is because institutions, hedge funds, and analysts do not pay attention to small cap stocks. This means that there are much less eyes on small cap stocks, which ultimately results in valuations being much more attractive. For example, H2O Innovation is a small cap stock that I found at $1.08, and at that price, the valuation was just $84 million. Yet, the company is producing about $140 million in annual revenue, and has positive EBITDA of about $15 million. So at an $84 million valuation, H2O Innovation was trading for less than 1x sales and around 5.6 times positive EBITDA, which I thought was very attractive. I also have another small cap stock that I've been buying into quite aggressively that I have not made a video on yet. It's actually grown into one of my largest positions because I just think that the valuation is so attractive relative to the overall market and the specific sector that this company is in. And ultimately, I think that the valuation of this business is so attractive simply because it's such a small cap stock, and really no one is paying attention to it. But anyways, the second reason that small cap stocks are such great opportunities is because it is much easier for a company with a $100 million valuation to 10x than a stock with a $1 trillion valuation. If the $100 million company 10x's, then it's worth $1 billion, which really doesn't sound unrealistic by any means. However, for the $1 trillion company to 10x, it would need to gain another $9 trillion in value, which is 5 times the GDP of Canada. or nearly half of the entire GDP of the US. So which one sounds more realistic and easier to do? 10xing the smaller company or 10xing the extremely large company? Now, many people do not like small cap stocks because they usually trade on the OTC, and people think that OTC stocks are much more risky. Now, while it is true that these stocks usually trade on the OTC, it is not true that they are inherently more risky, so long as you know how to find fundamentally sound businesses. When you invest in any stock in the market, you are really investing in the underlying business behind the stock price, and this is no different in small cap land. I myself just like to do a lot more research and digging into the small cap stocks that I want to invest in, just to make sure that I'm not missing anything and I know that it's actually a solid business. I also like to make sure that the company has a clear runway for continued growth before I start buying it. Peter Lynch, who is another legendary investor, loves small cap growth stocks that have proven their concept and are now expanding on it. He is not scared to buy incredibly small cap stocks, so long as the fundamentals of the business were strong and he thought they could continue growing them. I personally believe that small caps are where retail investors can gain an edge on the institutions, and I believe that they present no more risk than any other investment, so long as you do great research and know what you are investing in. I also believe that retail is missing a huge opportunity by writing off small cap stocks, and personally, I am going to keep looking for them and buying them. It's just really great to see that so many legendary investors also agree that small caps can provide great investment opportunities. But that's pretty much going to wrap up all of the key and important points that I found in this book. And as I said, I personally believe that this book is not worth the money because you can find all of the information that it teaches well organized right here for free on YouTube. I actually have a full playlist right here on my channel on how to read financial statements, and this pretty much talks about everything this book teaches. This playlist will also teach you pretty much everything the book does in about 40 minutes, and again, it's totally free. So if you're interested and you want to learn more about how to read and analyze financial statements, then make sure you go and check out my full playlist here on my channel. But that is pretty much going to wrap up the video, everyone. And if you enjoyed this video, then as always, please remember to leave a like on it. Leaving a like really helps out my channel and I really appreciate it. Also, thank you all so much for stopping by and checking out my video. If you want to see more content like this, then please consider subscribing to the channel to stay up to date with everything I produce in the future. But that's going to wrap everything up, so thank you all so much again, and I hope to see you all in my next one.